What's up, guys? In this video, I'm going to be letting you guys know a few things that we check on whenever we invest in properties. You can use this for single family homes, duplexes, quadplexes, apartment units, anything that you're investing in. You can use this formula to figure out if it's a good buy, to figure out if it's going to make money in the future, if it'll appreciate in the future as well. So here we're going to look at two separate quadplexes that we have purchased in the last few weeks. All right, so this Bruce one we actually purchased for 680K. This Cree one we purchased for 820K. Okay, so obviously the cheaper unit's going to be the cheaper mortgage. So this one's mortgage 2750. This one's 3267. So this one's making right off the gate about $500 more. $500 more to buy the thing, to have the mortgage. The rent on it, 3920. This one's rented fully. All 4 units are rented. This one actually has 3 units rented. They're currently at 4100. We think we could get at least 13 or 1400 on the next one, so about 5500 if we rent all of the units. Okay, so these are pretty easy numbers to come up with. Anybody could tell you those numbers. Potential rent. How I find this number in potential rent is I go on Zillow or rent.com or anything that's going to show you guys what houses are renting for, what units are renting for. And what we'll do is we'll search in the area of each one of these and we'll figure out the specifics. So 2 bedroom, 1 bathroom, 850 square feet, similar area. If somebody's selling 2 bedroom, 1 bathroom, 850 square foot, that's similar to your unit, what you would do is you'd figure out, okay, they're selling it for 1200. Well, now my unit's now worth 1200. A lot of times, especially in the hot market we're in right now, a lot of these are undervalued. So they're renting for less than they actually are worth, just on the plain market, without even having to do anything to them. And those are actually the best units that you can get into, ones that are depreciated in rent. So where maybe the owner has owned it for 20, 30 years. They're just trying to make money. That they bought it when it was a $150,000 quadplex. Now it's a $820,000 quadplex. So $150,000 in rent or in mortgage would be something like $800, and they're kicking out $4,000. So they're not having to hit the top rent market to make the property make money, basically make it profitable. But anybody buying a new one, we're not buying it at 150,000. We're buying it at 820 and 680. So we have to meet these potential rents. We have to make sure that they kick out as much money as they possibly can. So the potential rent, like I said, go on anywhere you can find it. Look where stuff is renting currently, what stuff is renting for right now. This unit, the Prusis one, about $1,200 a unit is what they're kind of in. This one, it's about $1,400 to $1,500 a unit is what this one is, but we think that we could elevate it at least $100 a unit. And I'll show you how here in a second. Down payment. So this is going to be the money that you're putting down to capture the property. A lot of people, investment properties, you can put 20% down. We like to put 25% down just because it lowers the interest rate just a little bit. So it's a short-term investment for a long-term gain. So we put 25% down on our properties just to get the better interest. So this one's 170, this one's 205, 25% of the total property. Okay, so fixes. We have this Spruce one needs $45,000 of fixes. Needs a brand new roof. The whole backside needs windows. Roof be 32,000, windows 8,000. One of the rooms needs fixed up, about 5,000. We've already got quotes on most of this, all of it but the rooms, because we're actually going to do the room. So we've already got quotes on it. We've got the seller coming in at $25,000 that they're gonna give us of their commission fees. So pretty much they're just giving us cash back when we buy the property. So whenever or this one right here is actually will be $6,000 worth of fixes. What we're gonna do to this one is each unit has, currently they're all sharing a coin-op laundry room. So 4 tenants have to share one laundry room and one washer and one dryer. What we're gonna do to this one is we're gonna actually, they have storage units that are right outside their front doors. We're gonna turn them storage units into washer and dryer units where each unit has their own washer and dryer. Obviously you guys can tell that would elevate the rent. If you're renting it for $1,400 and you're sharing a laundry room, you'd probably rent it for a little bit more if you had your own laundry room. And so that's where the $6,000 of this one's going to. This one right here has already been fixed and flipped. So this one, somebody bought it in 2019. We bought it in 2021. So they sat on it for a year and a half, 2 years. What they did to the thing is they just kind of revamped it. So they painted the cabinets, they redid the countertops, new carpet, lock and lay floors, vinyl windows, redid the roof. They fixed it up pretty nice, and that's how come they're able to kick out the market rate whenever you're renting it out. So the $6,000 versus the $45,000. So what we're gonna look at on these properties is we're gonna look at how much cash do I have to put into each one, and then we'll run through the numbers on what maybe the property can kick out in cash, because that's what we're really worrying about. We're not trying to have $1 million house on the beach that doesn't make money. We're trying to have a mobile home that has 100 units that's making $1 million. We're not worried about the properties. We're worried about what they kick out, what the value is, and good investments. That's what we're worried about. Okay, so what you do is you can add these two numbers, and basically it's the down payment and what it's going to cost to fix it. This is going to get you a good number on, in any of these fixes, we actually do about 5 years. So whenever I look at the property, I'll say, okay, for the next 5 years, what do I have to do today to make it last for the next 5 years, for it to be bulletproof for the next 5 years, where it doesn't, nothing major happens to it. You know, you got the roof is good, the siding's good, plumbing, electrical, sewer. You know, you just have the main foundation. The main things are buttoned up, and you don't have to worry about those. If they aren't buttoned up, this is where we're gonna fix them. We're gonna fix them in the first couple months we have it. That way that it's not a hassle as we get into it. So what we're doing is we're fixing it up. This one is gonna cost $45,000 in repair. Like I told you, the seller's gonna kick back $25,000. So it's really only $20,000 that we're gonna be paying in the repair. So this one will be 190. This one's a little easier, 6,000 to 11. And so to capture this house or this quadplex, we're gonna have to spend 211,000. To capture this quadplex, we're gonna only have to spend 190. So far it looks like this one's a better deal, right? We'll keep going on it. Okay, so current yearly profit. So how I get this number is I just subtract the rent, the current rent, from the mortgage, and that will actually give you a number. You times it by 12, and that'll give you the current yearly profit. This is basically just if we rented it out, what it is right now, what they're renting it out for, we would make this much money. So on the first one, it would be $14,000. On this CRE one, it would actually be $25,500. So this CRE one, even though we're gonna have to spend $21,000 more to get it, it's actually gonna make $10,000 more in profit per year. So in 2 years, it actually pays for the difference that it does. I already have a higher appreciated property. I already can rent the rooms for a higher, less hassle in the game, and you can already kick out $10,000 more. there's always going to be like the stove doesn't work, the leaking faucet, certain things like that. So even though this is only $6,000 in fixes, there's going to be cost in it, just from wear and tear on a unit. Whenever, same thing for this one, there's going to be extra stuff. So, if you have a roof, you want to get 3-4 quotes on it, it's going to take you 2-3 weeks to do that. You want windows, same thing. You want a couple quotes on it, it's going to take you time to do that. So anytime that you see a bunch of fixes, just know it's a bunch of headache, bunch of hassle as well. A lot of times why people go with these ones is because they're cheaper. In Colorado Springs, it's hard to get a quadplex for under $700,000, and so this one's a little bit devalued because there's some work to be done with it. Okay, so then we go to the projected profit. So the projected profit is, we basically do the same formula, but instead of using the rent, we use the potential rent. So we do potential rent minus mortgage, and then we times that by 12. That'll give us this projected profit. So if we can fix these units up, that's what this money already invested into it. If we could fix this unit up, it will profit 24,600. This one 32,800 almost. Okay, so this one, it'll close the gap a little bit now because this one's producing more, but this one's producing more. They're about $8,000 difference. About $8,000 difference in between what you can make off of these properties. Okay, so then we're going to go back up and we're going to look at how much money it's going to cost us to purchase these. Like we said, we add them together, 190 and 211. So the difference here is actually 21. $21,000 is the difference between cash that we're going to have to invest in either property. Okay, so once we get all the numbers figured out, then we could kind of like step back and analyze. Like I said, if we have time, we can look at this unit, and what we're gonna try and be doing on this unit is we're gonna dump cash into it, and we're gonna try and make this number go up as high as we can. So we're gonna influx cash into it, fix the unit up, try and make it a better unit to rent it for higher, and just to fix the repairs needed in it. We can call back an appraiser, and we can get a cash out refinance. There's a couple things that we're trying to do with these properties. First thing we're trying to do is get a good buy on them. So we want a property that's devalued in rent, so it's not renting for what the market rate is. We want a property that maybe the owner's been in it for a long time. Like I said, that's how you get the devalued rent, because they don't have a high mortgage payment. You're wanting to look at location. I look at location almost more than anything, even the price. The location, if you get the best location, here in 10 years, it'll still be the best location. And then people are always going to be wanting to bid on your location. It'll always be one of the higher ones in the market. If you get the cheaper ones, they're dime a dozen. Just think of it like a beachfront property. There's only so many of them that they make. Mountain views, there's only so many of them that they can make. You can't generate with as much cash as you can. You can't generate an ocean view unless you have the land. And so these are elite assets, what we're trying to capture. They're assets that are going to continue to grow up over time. And then hopefully we can continue to raise the rent over time. One thing we look at, over 10 years, almost all properties will go up in value in 10 years. Over 20 years, 99.99% of properties are going to go up over 20 years. Over 10 years, rent's going to go up. Over 20 years, rent's going to go up guaranteed. So we're betting these aren't short-term plays. We're not fix and flipping these. If you are a fix and flipper, you guys will be looking more at these numbers, trying to figure out how much money am I going to have to put into it to get it back to where I need to flip it, or where I could sell it, cash out refinance, whatever you guys do with that. What we do here is we're going to wait 3 to 5 years. And then what we're going to do is we're going to hope that these two appreciate in value. How are they going to appreciate in value? Well, the higher that you can make the rent number, or for us right here, it's potential rent. So the higher that we can make this, the more the bank will think that the property's worth. And it's not exactly that easy because they look at comps and comparable stuff. But I promise you, if you can show the bank that your property's producing a lot of money, they're gonna make it worth more. If it used to produce 3,000 and you make it produce 6,000, you're gonna almost double the value of your property. That's the game, trying to make this number as high as it can, because then this number directly affects this number. And so what we're wanting to do is fix the property up where it's really good for 5 years, where we don't have to just keep dumping money into it. We'll use the profits for any small repairs, heater goes out or leaking faucet. We'll use the profits for that, but we want to know what our influx cash is. How much on day one are we going to be investing in this property? And we're not going to try and keep dumping money into it. We're going to try and figure out everything it needs day one before we buy it. So then what we'll do is then we're going to cash out refinance. So we'll wait 3 to 5 years. So then we'll cash out refinance it. What we're doing with the cash out refinance, like I said, we're just trying to make the rent higher. We're trying to make the property look good, look appeasing. That way the appraiser will come and then they'll tell me, hey, this property went from 820, and let's say we do it in 5 years, and say now it's $1 million property. Well, how the bank will look at this is they're gonna look at it, okay, well, if it's $1 million property, I'll give you 80% of what it's worth. So they give me 80% of what it's worth, which would be $800,000. And first I'm gonna have to pay off my first mortgage. So the mortgage that this 820 is on, I'll pay it off. And then you can see I'll have about $180,000 gap in there. And that will be most likely what they give you in a cash out. So, you know, we spent 211, and then in 5 years they're gonna give us 180,000 back. So realistically, in 5 years, we've had this thing pay us, what did we say, $32,000 a year. So 5 times 32,000, 160 something thousand. So 160,000 it's paid us in profit. Then we go back to the bank, and then we take the money that we invested in the property, and they're going to give us most of it right back. So this 180 they'll give us back in a cash out refinance. And the best part about the cash out refinance is that this 180 they're going to give it to you, and it's going to raise your payment. It's going to be $1 million payment now, so this will be about $5,000 payment for $1 million. It might be about $4,000 for $1 million. But what it's going to do is you're going to actually have 180 in liquid cash, tax free. And the tax free, I can't tell you guys how important that is. That's why we don't fix and flip properties. If we did fix and flip a property, I've done this before, but I will show you why you don't fix and flip, or why we don't. You guys can, but we don't. Fix and flip, you're going to get a capital gains tax. It's 30% right now. It's going to go 42% next year. So let's say that it's just 30%. So then, you subtract $30,000. And this is a cap gains, and then that's a tax. So tax, capital gains tax, we're going to get down to 70,000. Then they're going to put this 70,000 into your income bracket. Your income bracket, depending on how the government taxes you, it's going to either be 30%, 40%. Let's say that they tax, let's say that they tax another $30,000. Say it's at 40%. Now we're at $40,000. So you made actually $100,000, and you're actually left with $40,000 at the end of it. I would rather just hold on to the property, make it make me money every year till I die, be able to cash out, refinance this, pull the $180,000, and then this is how you guys hear sometimes people say leverage your assets. This is leveraging an asset. What we're doing is we're taking the asset. The bank will lend me more because I got equity in the property. We're gonna pull the equity out of the property, and then they're gonna give me another loan, and then I'm gonna funnel this 180 right into another property that does something similar to what these are doing. And so it's instead of having to get this 180 taxed, and you could see you almost end up with none of it, we actually ended up with 40% of it is what we did here. You know, if you ended up with 40% of this, it'd be like $90,000 or $100,000 maybe. They're gonna tax almost $80,000. If I cash out refinance, they don't tax any of it. It just raises my payment because it's debt, so I'm just going into more debt with the bank. But I'm pulling the cash, leveraging I'm leveraging this one for more debt, right? So I'm getting another $180,000 in debt, but then also I'm leveraging the asset into another asset, but then I'm leveraging the asset into more cash, because I'm just taking the cash that I initially invested in this property, pulling that cash out, and I'm going to invest it in another property. This is, like I said, why we don't cash out why we don't fix and flip, and why we use the cash out refinance. It's just because it's better. If you guys see some of these bigger real estate investors, they're going to say exit plan, exit plan, exit plan. I don't have an exit plan. I'm in it forever. I'm trying to just make freedom is what I'm trying to do. So I'm not trying to, oh yeah, I got a lot of money on paper, but then the government takes most of it. I'm trying to have liquid cash, or an asset that pays me monthly in liquid cash, that I could live off of. And then I need an asset that in the future I could leverage against to get another asset. This is a bulletproof system. I think it's 90% of millionaires in the world have made their own millions, and I think it's 80% of millionaires use real estate to make their millions. So if you guys want to have financial freedom, if you guys want to have be able to do stuff with your life, you know, everybody says, oh, how can I, you know, be a good mom and work out and have life balance and friends and work and the whole nine. This is how you do it. You free up 8 hours of your time where I don't have to work a bunch of time to get $32,000. I just have to invest my money in the right spot, make sure it makes sense, always understand the back lay of it, always understand what we're going to do next, 3 to 5 years, what are we going to do on the thing. And as long as you're making smart decisions in these properties, they're going to continue to appreciate, rents will continue to go up. This number will look small in the future, just like the person that bought the Quadplex for $150,000. They thought it was expensive in the 80s. 2021, it's not expensive anymore. $820,000 is what I'm gonna buy the same Quadplex for. And so this over a long period of time, I feel like this is the only way to get the passive income that everybody's trying to. You can invest in Bitcoin, which I recommend. You can invest in stocks, which I recommend. You can invest in mutual funds, which I recommend. You can invest in a lot of stuff. But if you're not doing real estate, you're doing something wrong. Thanks for watching the video, guys. See ya.